Hello everyone and welcome back to today's video. Today we're going to be talking about classic chart patterns. We're going to learn how to identify them and how to use them to minimize our risk and make profit. We're going to learn when to set up our stop loss and take profit points. So if you're interested in trading or analyzing chart at all, you need to know these patterns. And if you don't know these patterns, then don't worry. After watching today's video, you're going to have all the information that you need. And at the end, as a bonus, there's going to be 5 rules that you always must follow. So let's start with the classic charts patterns. So we have two types of patterns. We have reversals and we have continuation. Reversals mean that the trend is going to reverse to a different direction from where it's headed. So let's say we have an uptrend, we're going to see a pattern, then the trend is going to change to a downtrend. Continuation means basically the trend will continue in the same direction that it's starting. So we have two types of patterns in each category. We have bearish and bullish. Bearish means that the market is going down. Bullish means that the market is going up. Let's start with the bearish right here. So we have 4 different types here. The first one is called double top. Okay. So notice how the trend is going up like this. It hits this line here, which basically going to be our resistance line. Then it bounces back down and hits this area here, which basically going to serve as our support line. Then we notice that the trend is also going up again and hitting the same old resistance line, then dropping down, basically forming what it seems to look like a double top. So we have 3 main things that we can set up before trading with this pattern. We have the entry point, we have the stop loss, we have the take profit. You gotta remember, having confirmation on any pattern is really important to minimize your risk and to make sure you're actually trading with brains, basically using your brains to trade. So you're gonna set up the loss roughly in the middle, like in the middle between the top of the trend and the bottom of the trend. The entry point will be a little bit after the trend has actually broken the neckline, which is this line, the support line, because the confirmation in this pattern is basically when the trend closes after breaking that support line. And you're going to take profit at the end of this trend where the pattern has actually started. So this pattern you can actually use, by the way, in any types of chart, like candlestick charts or bar charts, or even with the line chart. Okay. So the second one we have is triple top, which is basically the same as double top, but it has 3 heads instead of 2. Notice the trend going up, down, up, down. So we see here it formed actually triple tops. The same thing, you're going to set up the stop loss a little bit below the half of the trend here in this range. The entry point is going to be after the trend actually broke. The market broke the support line here. And you're going to take profit where actually roughly where the trend kind of started. So head and shoulders. Head and shoulders is basically like triple top, but notice it's called head and shoulder because it similarizes a head and shoulders. So the trend start, this is the left shoulder here, this is the head, and this is the right shoulder. So it works in the same way. Same thing, the stop loss is going to be in the middle here. The entry point is going to be after the neckline has been broken, and you're going to take profit roughly where the trend actually started. The last reversal is called a rising wedge. Okay, so notice we have a downtrend, an uptrend going here up, and notice how the price is actually moving, getting lower highs and higher lows. So it's kind of like wedging. So it's like getting closer to each other. This basically signifies that the market is due a reversal when the break happens. So notice here, when the entry point is set up here is basically when the trend or the market broke this channel here, this wedge. Your stop loss is going to be at the top of the channel or wedge, and you're going to take profit roughly like 2 to 3, 1, depending on what kind of rates you're taking in your trades. All right. So this is all the bearish reversal. Now let's look at the bullish reversals. So the bullish reversals are basically the same thing as the bearish one, but it's in reverse. So notice here we have a double bottom, okay? Notice we have a downtrend. The trend hit the support line here. It hit the resistance line here. Same thing, we're going to entry after the market actually broke the neckline. Our stop loss is roughly going to be in the middle. Going to take profit here where the trend started. If you notice, like if you connect the line, the tops should be at the same place. So in triple top, triple bottoms here it's the same thing. No differences at all. Trend going down. We have one, two, three bottoms. Entry point, take profit, stop loss. So inverted head and shoulders, just like the head and shoulders, and just like the triple bottom. Notice that the trend is going down. It hit the first resistance line here. It hit the support line here. We noticed that the head is coming out of the support line. Then it went back into the range. And your entry, stop loss, and take profit are going to be in the same spot as we seen before. The entry is going to be above, around here, above the neckline. When you have confirmation that the trend is the pattern is actually activated, your stop loss is going to be roughly in the middle here, and your take profit is going to be where the trend has actually started, like at the same line. Falling wedge is the same thing as a rising edge in the fact that the falling wedge, like you have a downtrend coming down. Notice how the price is like you're getting lower highs and you're getting you're going lower highs and lower tops. So notice how it's kind of wedging together. Same thing is going to happen here. Your entry point is going to be above here when the market actually opens above this channel or wedge. Your stop loss is going to be at the bottom range of the wedge, and you're going to take profit where the wedge kind of started. And that's all the reversal. That's all you need to know about them. Now let's talk about the continuation. So we have bearish and bullish. We're going to start with the bearish. So the first one is called rising wedge. We've seen it before in our last example, but notice here the rising wedge we have right here is in a downtrend. Okay, as here we see the rising wedge is in an uptrend. So a rising wedge in an uptrend is a reversal. Okay, but a rising wedge in a downtrend is a continuation. So notice how the trend is going down. It started trending in this wedge. As soon as the trend actually broke the wedge, the entry point is going to be roughly around here. Notice how the entry point lines up with the last point where the market actually was. You see, like, so we draw a line from here, like if you do this, this is basically going to be our entry point. You're going to line up the last low of the trend and you're going to line it up with when the trend actually broke this wedge. So our stop loss is going to be at the top of the wedge, and their take profit is going to be roughly where the first like the first low in the trend started. Like notice here, this is the first. This is right here where you take profit. It's a very simple pattern. It's really not that complicated, but everybody should know this because they're very general. You see them often on chart, and they do actually control big movement in different markets. So the bearish flag. Now it's called a flag because it resembles a flag. So this is going to be the pole here of the flag, and this is going to be the flag. So just like a wedge, but notice how the wedge is coming close together. The flag is basically parallel lines. So the trend starting to go down. We see the trend actually moving. Same here. Stop loss is going to be at the top of the flag. The entry point is going to be lined up with the last low of the trend. Your take profit is going to be in the bottom. Okay. A bearish pennant. So here's what happened. Pennant is basically just like a wedge, but it's more like this. So it's closed at the end, and it's like getting closer and closer. The trend actually like starts very wide, and it's really get tight together. So notice how the trend is going down. We have a couple of action inside this pennant. The trend reached top, bottom. Entry point is at the last low here. Your stop loss is going to be at the top. Your take profit is going to be in the bottom. And the last bearish reversal is called a bearish triangle. So this, notice how this is a descending triangle. So notice how it's going down like this. So it's a descending triangle. So the trend is gonna actually trend inside this triangle. As soon as it broke down into the bottom, your entry point is gonna be a little bit after the breakdown. This is our confirmation. You gotta remember to wait for the confirmation. Your stop loss is gonna be at the top where the point basically was, and your take profit is gonna be in the bottom, depending on what risk or ratio you're taking into your profit, like 2 to 1 or 3 to 1, etc. Now let's talk about the bullish patterns. So right here we have a falling wedge, we have a bullish flag, a bullish pennant, and a bullish triangle. So falling wedge is basically the same. Notice how the trend is going up, trending inside that wedge. Our entry point is going to be line up with the last stop of that trend. Your stop loss is going to be at the bottom, and you're going to take profit roughly line up with where the trend kind of started going down. Sorry. So bullish flag is the same. So this is the pole. If you notice the first line, and this is the flag. If you notice, like it looks like a square, it's like a flag. The trend is going up and down inside the flag. So as soon as it broke the upper end of that flag, we're gonna have our entry point. Our stop loss is gonna be at the bottom of this pattern, and you're gonna take profit on the top depending on your risk to win ratio. Bullish triangle. Notice here we have an ascending triangle here, not a descending one. Notice how the triangle is actually going up. Okay, so the trend is going up. We have some kind of movement up, down, up, down, up, down. As soon as the triangle actually broke this pattern, our entry point is going to be here after the confirmation that it actually closed there. The confirmation basically it means like when the market broke that pattern and the next day it closed above that pattern. That's what a confirmation means. Your take profit is going to be on the top. Your stop loss is going to be at the last bottom here in the triangle that you drew. So this basically are all the pattern that you need to know. These are the classic pattern that you see in different types of chart. Everybody should know these. These are common knowledge. Make sure to remember them. Now I'm going to tell you about the 5 rules that you should always follow. Because these patterns are quite common, so a lot of mistakes do happen with them. So here I drew some examples. So the first one is called an ascending triangle. Okay, remember an ascending triangle serve as a reversal in is if appeared during a downtrend. So if we have a downtrend, okay, and we see the trend forming and trading into an ascending triangle way, this basically serves as a reversal. So we know that the market is going back up again. A second one is called, sorry about that. A descending triangle serves as a reversal if appeared during an uptrend. Okay, so if we have an uptrend and we notice that the market is actually trading in a descending triangle pattern, we know that the market will go down again. Just keep an eye for that. Third one here is called basically rising wedges serves as a reversal appear during an uptrend. Now notice here ascending triangle in a downtrend, descending triangle in an uptrend. But here a rising wedge in an uptrend is basically a reversal. So notice how the market is going up and it's actually trading in this wedge formation. As soon as it broke, you're gonna drop, the market's gonna drop down. Notice this red line basically represent the stop loss, and here's where basically you take your profit over here, depending on your win to lose ratio. So now our fourth rule is going to be falling wedges in a downtrend serves as a reversal. So notice here ascending, downtrend, descending, uptrend, rising, uptrend, falling, downtrend. Don't mix those up. So same here, market's going down, it's trading in this wedge formation. As soon as it broke, notice how the market went back up. And our last rule that you need to remember, flags and pennants are always serve as continuation patterns. Like the market goes up, keeps on, market goes up, trades a little bit sideways, then it keeps going up again. And that's basically all you need to know about the classic chart pattern. Thank you all for watching. Hope you learned something here. And make sure to hit the like button and follow me for more videos. I have a lot of videos that help basic to help teach the basics of trading. So if you have any question, please don't hesitate to ask. And you all have a nice day.